All right, welcome. What we're about to go through is a deep dive into the Al Brooks method for trading price action. Now, just a heads up, this isn't going to be a high-level overview. We're getting into the nitty-gritty, a really specific, rule-driven way to read and trade the market, literally bar by bar. So here's what we're going to cover. First, we'll hit the foundational logic, the core philosophy. Then we'll talk about reading market context before you do anything else. After that, we'll dissect the anatomy of a single price bar. Then we'll get into the core trade setups, the logic behind risk and reward, and finally, we'll wrap it all up with a trader's decision tree. Okay, let's get right into it. Before we even think about a single trade setup, you absolutely have to grasp the fundamental philosophy of how Al Brooks looks at a chart. And I mean it, this is a total shift in perspective from almost everything else you might have learned. These 6 principles you see here, they're everything. The big takeaway is that trading is a game of probabilities, not certainties. You're not looking for a perfect can't-lose signal that doesn't exist. You're looking for a statistical edge. And that means you have to accept that losses are just part of the game. Your job isn't to predict, it's to react. To trade what the market is doing right now, not what you think it should be doing. Now, this always-in concept, it's absolutely crucial. What it means is that at any single moment, the probabilities are leaning one way or the other, either long or short. So, for example, after a huge bull trend bar, the market is always in long. Now, that doesn't mean you personally have to be in a trade, but it does mean you need to have a directional bias. The game is to figure out that bias and find trades that go with it, and you don't switch your thinking until the price action itself screams at you to do so. All right, so how do we actually apply this stuff? Well, first things first, before you even think about an entry, you have to classify the market's context. Why? Because a setup that looks amazing in a trend will get you absolutely shredded in a trading range. Look, every single chart, doesn't matter the time frame, it's always in one of these 4 states. You've got your strong trend, that's pure momentum. Then you have a weak trend, which is kind of choppy and usually stuck in a channel. Then there's the trading range, which is just a big tug of war, a state of balance. And finally, you get these transition phases. That's the messy part where the market's trying to figure out what's next. Your entire strategy has to adapt to whichever one of these you're in. And this right here shows you the difference perfectly. A strong trend, you're seeing big, powerful bars with tiny tails closing way up at their highs or lows. There's almost no overlap between them. In that environment, you're looking to buy pullbacks and trade breakouts. But a trading range, it's the total opposite. You see tons of overlapping bars, big, prominent tails, and weak closes right in the middle. Here, you do the exact opposite. You fade the edges. You sell the breakouts and buy the failures. You have to remember, context is king. It overrides every single setup. So to really get that context, you have to learn how to decode the story that every single bar is telling you. And I mean with extreme precision. Every little part of that bar is a critical piece of data. You know, every piece of a price bar is telling you something. A strong close, let's say in the top or bottom quarter of the bar, that's pure conviction. One side is in control. But a weak close, somewhere in the middle half, that's just indecision, a lot of two-sided trading, and a long tail, especially if it's like a third of the bar's entire size, that's a huge screaming sign of price rejection. Then you've got overlap. If a bar overlaps a lot with the one before it, that tells you the market is balanced, which usually means, you guessed it, a trading range. You have to look at these details on every single bar to see what's really going on. Okay, so now that we've got a handle on context and how to read individual bars, we can finally get into the exact rule-based entries that Al Brooks uses. This is where all that theory turns into a specific step-by-step action plan. The trend pullback. This is one of the bread and butter trades. Think about it. In a strong trend, the big institutions are just waiting for a dip to buy more. Our job is to piggyback on what they're doing and get in at the exact moment the trend looks like it's about to resume, after a little breather. So let's get super specific with the rules for a bull trend pullback. First, context. You need a confirmed bull trend, no question. Then, you're watching for a pullback. This is usually going to be a bear bar, maybe a doji. That's your signal bar. Now, here's the key. The entry is not market. It's a buy-stop order, placed just one tick above the high of that signal bar. Your stop loss, one tick below the low of that same bar. That's your I'm wrong point. We don't just jump in. We wait for the market to prove us right by hitting that buy stop. Okay, we have to keep hammering this home. Most breakouts fail. A valid breakout is a big, strong trend bar that closes outside a key level. You can trade that by entering one tick beyond its close. But, and this is a big but, if the very next bar immediately turns around and closes back inside that range, that's a failed breakout. And that failure is actually a fantastic, high-probability reversal setup. You're basically trading against all the amateurs who got trapped buying the high. And this quote really says it all for trading ranges. As soon as you've identified the context is sideways, you completely flip your mindset. You're not looking for trends anymore, you're hunting for failures. That means you're putting in limit orders to sell up near the old highs and buy down near the old lows. You're betting that the range is going to hold, and you're essentially taking the other side of the trade from those trapped breakout traders. All right, let's talk about risk and reward. In this system, where you put your stops and where you take your profits, isn't a guess. It's not based on feel. It is dictated entirely by the price action on the chart. So think about your stop loss this way. It's simply the price point where your entire reason for taking the trade is proven wrong. That's it. For that bull pullback trade, if the price drops one tick below the low of your signal bar, well, the bulls didn't show up. The trade idea is dead. So getting stopped out isn't you failing. It's the system doing its job perfectly, protecting you in a game of probabilities. Now, this is a really important point about taking profits. Yeah, you have a logical target in mind, but you're managing the trade bar by bar. So if you're long and suddenly a giant bear reversal bar prints and closes on its low, you don't sit there and hope your target gets hit. You get out. You take your profit right then and there. Why? Because the market just handed you new information that says the odds have shifted against you. The name of the game is to scalp quick profits when you have momentum, and you only hold out for that big swing trade if the price action stays incredibly strong in your direction. Okay, let's put it all together now. We're going to build a step-by-step checklist. Think of this as your pre-flight operating manual that you have to run through before you ever click the mouse. This right here, this decision tree is what gets the emotion and the guesswork out of your trading. You must be able to answer every single one of these questions with a concrete, rule-based answer. If you can't, you simply don't have a trade, period. So you ask yourself, what's the context? Is the market always in long or short right now? Is this bar a valid signal for a setup I know inside and out? Where is the exact entry, the exact stop, and what's the minimum reward I can reasonably expect? And this quote really gets to the heart of it all. You have to burn this into your brain. Trading is a game of probabilities. The whole point of this incredibly detailed, rule-based system isn't to find some holy grail that never loses. It's about finding a small statistical edge that, if you execute it flawlessly over and over again, makes you money in the long run. So this brings us to the final and maybe the most important question. And honestly, it's less about the chart and more about you. With this method, your win rate will often be less than 50%. The profit comes from your winners being bigger than your losers. So the real challenge isn't learning the system. The real challenge is, can you actually do it? Can you execute an imperfect system perfectly day in and day out? And of course, please remember, all of this is for educational purposes only. It is not financial advice. All trading involves significant risk, and it's very common to lose money.